Good morning and welcome to the Saxo Bank Morning Call. It is Monday, January 7th, and we had a very interesting session on Friday, to say the least, with Fed Chairman Powell out in an interview with the two former Fed chairs, Bernanke and Yellen, and really indicating that he is listening to the market. And this was seen, obviously, by the market as quite a dovish tilt. Huge rally in risk appetite, Peter. This combined with other news, strong jobs report, and then we saw this Chinese triple R cut, what you called sort of a triple whammy here for risk appetite. And we've seen equities really having a stellar session.
We were up 3.5% in U.S. equities, and if you look at the chart here, I communicated on Twitter that I thought the probabilities were now tilted in favor of the S&P 500 reaching the 2600 level before 2400 as a retest of those lows, and we are sort of halfway there now. And I think it seems like sentiment is sort of building, but don't be too optimistic here. There's still a lot of events from Brexit. We still have the standoff between the U.S. and China on the table. So, but for now, I think we are moving higher in equities.
Okay, let's take a look at what Powell actually said. I think it's a pretty interesting pattern here. Obviously, the key thing is that the market has sort of been screaming at Powell to listen to the risks of what's going on here, financial conditions, tightening dollar liquidity, the issue over the balance sheet. And he is listening, and that was made clear in his comments. The Fed will take into account the market concerns. So opening up the idea that the Fed is listening to markets. The markets are sending downside risk signals, but he feels that on the third point that the market is getting way ahead of the actual data. There seems to be a very big reluctance to think that anything's wrong with the economy, just between the lines of what he's saying. He's saying, look, economic momentum is strong coming into 2019. Fourth point, look, the Fed is always prepared to shift its stance of policy if needed. They're hearing a lot about the balance sheet, but interestingly here, so yes, we're hearing a lot about this, and this is a key part, I think, of the market's concern, but he doesn't believe that the Treasury issuance is a big part of the market turbulence. I'd like to know what his thoughts are, what is causing the turbulence, but that's, it is what it is. He wouldn't hesitate to change that balance sheet policy if needed, and then more on the link between wages and inflation, and that he would not resign, finally. He would not resign if asked to by President Trump. So a very interesting appearance, to say the least, and the market sort of taking the signal that he's listening to the market and running with it. I'm a little bit skeptical. I think there's this problem of incoherence. Just if you look at what happened on Friday, we saw a very, very strong U.S. jobs report and rates actually rising strongly when the Fed is supposed to be suddenly dovish. So we have a very mixed signal, I think. And I show the 2-year here on the chart, the U.S. 2-year benchmark, Treasury benchmark, where we rose some 10 to 12 basis points on a single session, the biggest rise in 2-year rates. I don't know how far back, months back, if you will. And then on the jobs report itself, I see here at the top, you can see here on the top of this chart, net 312K on the gains, and on top of that, a 58K positive revision. And importantly, as well as average hourly earnings rising to new highs for the cycle, even though the Powell is saying that there's a bit of a weak link between the wages and inflation. Let's keep in mind, it'd be very interesting on this on the wage front as we go into 2019. 22 U.S. states are seeing their minimum wage rises as of the first of this year. So we could see some interesting data there.
I still find it so puzzling that he says that there's this incoherence between the data and the market, and the market is ahead of data. The market will always be ahead of the data. That's the whole point. Most macroeconomic data are either lacking or coincident. I mean, the big plunge in oil, it doesn't come out of nowhere. And the same with when you have big moves in the market, they are statistically significant. So just ignoring them and saying they're too far ahead. I mean, for me, it's just typical economics language for they don't know what they're talking about. Seriously.
Yeah, and also you bring in oil here, and it feels to me, if you look across markets, where do you run and hide oil? We see oil doing essentially the same thing as equity markets.
Yeah.
There seems to be there's nowhere that you can escape the correlations.
Well, at least it actually looks like commodities are receiving a general bid as we start 2019, and crude oil has made a quite strong recovery. I think the market is getting a little bit more, because as Peter mentioned, a lot of it was sentiment driven. We dropped 40%. I mean, the world didn't change overnight which warranted a 40% drop. Now we're starting to recover a little bit, and I think the fact that we are now seeing an action on the supply side, that's going to have an impact. But also, I think U.S. producers are starting to feel the pinch from these low prices. So
yeah, we know some of that supply is going to come off, or at least the growth in the supply has to come off the boil.
So the market seems a bit more balanced now, and on that basis, we're getting close to some interesting levels. But we'll take a look at that later.
Okay. I picked up this tweet from David Rosenberg. I have the tweet here. I think it's important to keep in perspective. And great sort of forensic comments from Rosenberg on all the data, the releases that you don't get from the headlines when you see these releases coming out. And he's obviously very skeptical on the course of the state of the U.S. economy. And he points out that apparently that most of the gain, or all of the gain, virtually coming from teenagers in this payrolls growth. And that was a bit underlined by the fact that the participation rate also rose, and that's why you see the actual unemployment rate rising as well. So some skeptical spin there on the quality of this data. And then in FX, if we look at the chart here, I mean the currency you obviously go to when you have China easing, U.S. potentially easing, and a shift of an attitude on the dollar is the Aussie dollar. Positioning as well. We're not getting the latest positioning updates because of the U.S. government shutdown, but we see that triple whammy of factors hitting Aussie dollar the most here. And the question is, how much can it extend? And I think, again, the correlation will be very much in line with risk appetite and whether we see a continued bid on the back of this story.
And that's also one of the reasons why we saw copper being a very strong performer on Friday. If we see China step in to increase their spending, then the Aussie dollar is also signal that some slight better news, and copper really reacted to that.
And I didn't read the details, but I saw some headline about a new $100 billion plus high-speed rail project. So I guess there's a few pounds of copper that go into a project like that. Peter, you've decided to take this point. You wanted to make a point about relative valuations here. Now that we've seen a pretty decent bounce. We were talking about it this morning, almost 10% on the S&P, the bounce from the bottom. And you've got your valuation model is actually picking up on especially Japan.
Yeah, it's not only Japan, it's also coming off talking about the Aussie dollar, it's also Australia. So, and I've been talking about this for a couple of weeks now, that probably the best way to play Chinese equities is from this indirect angle, because if you look at the mainland shares, if you go to the table, you can see that mainland Chinese equities are at the bottom. It's only worse by South Africa. But so if you can see Hong Kong and Japanese and Australian equities are in the top. So basically a lot of the cyclical equity markets that are sort of would be linked to global growth in China have low valuations. So that's potentially, I think, where you can get some upside. And look at the US, just for go back to the table, John. Just look at the US. The 12 months return is just staggering. Just again outperforming almost every single equity market on a relative basis.
But still in the top third of the rankings of the U.S. market and your valuation model. Yeah,
and that's because the momentum is so strong that it sort of offsets some of the high valuation that is still a little bit of a concern for U.S. equities. But look, for Australia and Japan, I think it could be quite an interesting opportunity. But if you go to the chart here, I brought with me the Nikkei continuous futures, and here you can really see, I think actually Japanese equities were one of the equity markets from the top in October and to the bottom in December that fell the most, and it hasn't really had the same bounce back as U.S. equities. So if there is some rhythm or link in this in these equity markets, I would not be surprised to see the Nikkei go maybe and test at 2100.
Yeah, there's a very key band of resistance, just as a technician eyeing the chart there, that 20,000 to 21,000.
Yeah, 21,000. Yeah, exactly.
That whole zone there looks pretty critical on that chart.
Yeah.
Ola, we talked about oil. What are your thoughts here? I mean, we've seen a massive slide. We're hopefully getting some supportive comments from Powell that supposedly could ease up on dollar liquidity globally, although I think we need to see more from the Fed to see actual dollar liquidity ease up. What's the story here for whether we can get back above key levels?
Well, I just brought WTI today, and as you can see, it has been bouncing off quite a critical level where we found support in the past, 42.5. And now, as we're moving higher, this key psychological area 50 is coming back into play. So really, the focus this week will be whether we can manage to break it back into this old consolidation range between 50 and 55. There was some supporting news on Friday that the rig count in the US dropped by 8. You can see it in that little table that we have seen a slowdown in the number of new rigs in the US over the last year. First half up 111, second half up 27 only, and now down 8 in 1 week. So that's providing a bit of support. But the weekly inventory report also out on Friday actually did paint still a picture of a market where inventories are not really coming off because of the continued increase in production. But at least the market sentiment has improved somewhat, but we need to see how they do this week. And I think just briefly on, you mentioned yourself, we had some questions about it. The cut report in the US has been delayed due to the government shutdown, so we're now missing 2 reports. It's actually some very key periods that we've been through. So the market is left a little bit in the dark, both in currencies, in stock indices, in bonds, and primarily, and obviously also in commodities. So we need to wait for the government shutdown the government to reopen before we can get these data out.
Yeah, Trump claiming it can go on for years. I'm a bit skeptical whether that's the case.
That would be very frustrating if that happens.
I don't think that's going to happen. Let's go to our economic calendar for today. It's a very interesting week shaping up. Obviously, the play out of the reaction to what unfolded on Friday. And a reminder that ISM manufacturing last week was very low. It registered the biggest drop for a while. I think a lot of that energy related. We saw that the last time around in 14 and 15 when oil prices collapsed. We have the ISM non-manufacturing up today, and this has registered 360-plus levels for 3 months in a row, the first time ever in that data series going back 20-plus years. So, maybe underlining Powell's idea that the economy is going strongly, and if not, then it's a new data point. But safe to say, the rest of the week, plenty of noise on the Fed front. We have the new set of voters, several of them out speaking. That's Rosengrain on Wednesday. We have Powell himself on Thursday, together with Bullard, Evans, also Evans on Wednesday, and Clarida. So, if we're going to get thoughts on where the Fed is standing here and the FOMC minutes, it's pretty clear it's going to be this week. Other aspects, the Bank of Canada meeting, no move expected there. They clearly downshifted at their last meeting, and then the CPI, I think a minor point at this point from the U.S. on Friday. Wanted to point out, we're getting from BBC News today that the date has been set for that Brexit vote in Parliament next Tuesday. I still don't see how we have the votes for this terrible deal that may put together with the EU. So that's going to be a very interesting vote, and maybe we finally get some sterling volatility on the back of that. That's it for today. We'll be back tomorrow with the Saxo Bank Morning Call.